if you look at 10-year treasuries today, and you look at where the market thinks the 10-year treasury rate will be 6 months from now, a year from now, it's actually lower. So when you have a combination of rates just coming down to begin with, and then the curves inverted and expected to go even lower, that creates an area where you get people interested in maybe locking some of those rates.
Joining me today is Gavin Duckworth, Managing Director, Hedging and Capital Markets with Chatham Financial. Gavin, thanks so much for joining us.
Thanks, Matt. Good to be here.
Now, with the Fed's increases in interest rates, how are REITs minimizing their exposure to interest rate risk?
That's a very good question, and we've had a lot of activity in the last, I'd say, really the last 12 to 18 months as the Fed has started to raise interest rates. Our REIT clients have really taken advantage of, I would say, 2 or 3 different hedging tools to help them mitigate that risk. For our clients who are investment grade, who have the ability to issue debt, unsecured bonds, and really even our clients who do private placement debt, any type of debt that's going to price over treasuries in the future fixed rate debt, they will look for opportunities when interest rates come down to lock in those rates in the future so that their bond issuances, at least the Treasury component of their bond issuance, that risk has been mitigated through either a Treasury lock or a forward swap. So these are the main 2 tools that we see. We just saw last week as rates came down significantly due to some of the things happening in the banking sector, quite a few CFOs called and said, hey, rates are down 30, 40 basis points. I know I'm going to be in the market 6 months from now to a year from now issuing debt. I'd like to take some of that exposure off the table today through either a Treasury lock or a forward swap. So that's a tool that many REITs will use. The other thing that's another thing that a lot of our clients are, aware of is that right now, Matt, there is an inversion in the curve. So if you look at 10-year treasuries today, and you look at where the market thinks the 10-year treasury rate will be 6 months from now, a year from now, it's actually lower. So when you have a combination of rates just coming down to begin with, and then the curves inverted and expected to go even lower, that creates an area where you get people interested in maybe locking some of those rates. So I think that's probably the number one way that REITs are addressing that risk, but also just future floating rate, interest rate exposure. There are a few different things that can be done there. For our clients who have unsecured term loans, often it's just working with a relationship bank and saying, hey, I want to lock down years 3 and 4 of my term loan that's currently floating. And they might have in the past been willing to let that float and not as worried about it because it's out there. But again, because of that inversion in the curve, those swap rates are fairly attractive to lock rates out 3 or 4 years based on where we are today. And then I would say the last thing I would bring up is even our clients who are maybe going to be entering into a secured mortgage, you usually can't lock that rate until the loan closes. But because they're so worried about where rates might be tomorrow or in 2 months or 3 months, we've seen a lot of our REITs clients work with that lender to actually allow the borrower to enter into a forward swap before the loan closes, meaning they'll lock rate today for a loan that closes in 3 months maybe. And there's really 2 ways that they can do that. The ideal way is for the parent REIT to provide a guarantee. In other words, the operating partnership entity of the REIT will basically secure the swap while it's out, between the time it's executed and when the loan closes. The moment the loan closes, the asset in the loan will provide the security for the swap. So for those 2 or 3 months, a parental guarantee can allow the swap to be executed ahead of time. And if that's not on the table, we've even had some clients who are willing to enter into a credit support annex, and that's part of the ISDA. And what that allows the client to do is to, it's not ideal, but they actually would post collateral during those 2 or 3 months if the swap moves against them in value, and then that CSA goes away once the loan closes. So these are the tools that we see clients using, and over the last, any of our clients who've executed hedges over the last 2 years, those hedges have played out very well for them.
And what do you see your REIT clients doing at this point for any LIBOR debt or LIBOR hedges that have not yet transitioned to SOFR?
Matt, that's another good question because it's something we've been working on almost full time for the past year. If we had clients who were transitioning debt and hedges last year, it was relatively easy as far as getting the swap to go from LIBOR to SOFR. The execution charges were low. The basis adjustment that we needed to figure out in order to do that was favorable for our REIT clients. So we had clients who were transitioning their debt last year and their swaps and actually coming out at an all-in lower cost of debt going through that process. As we sit here today, that basis adjustment is not as favorable. The execution charges have gone up significantly. And we're at a point now where in some cases our clients are going to be paying, maybe 3, 4, maybe even 5 basis points more after they transition. So I would say many of our REITs right now are kind of slowing down and saying, you know what, maybe we're just going to wait to transition the swaps once we get past the June 30 cutoff. And at that point in time, LIBOR will no longer be a representative index, and so we'll rely on fallback language for both the debt and the swap to kick in. So what does that mean? Most of the debt that we see, the benchmark replacement index is hardwired to be term SOFR, so the debt's going to fall back to term SOFR. The swap, if they do nothing, rather than paying a lot of execution charges today and a narrowing basis, they're just going to maybe let it fall back under the ISDA protocol language. And that fallback language is based on daily compounded SOFR. The issue they have to deal with is if their debt is falling back to term SOFR and the swap is falling back to daily compounded SOFR, there is some mismatches there that they might not be comfortable with. So these are things we're working with our REIT clients on today to kind of think through, does it make sense to pay the larger execution cost today and just be done with it, or wait for the fallback language, which might not have any execution costs, but if your swap is compounded daily and your debt is term SOFR, that's a mismatch that might not play out very well in a month where the term rate is much different than the daily rates.